a lot of people think the price of gold at 4,000 is high. I don't. I think it's low. I think gold's going to 10,000, 20,000, 50,000 because that's how much fiat money has been printed. In the same way that I think Bitcoin is going to much higher prices too.
If the commercial banks go long and the managed money is nearly record short, how do you think this ends up in the next few weeks? It's called squeeze. It's called margin calls. It's called, if I had a gun to my head, silver goes much higher very soon here as that managed money position starts to unwind. It's going to happen. The bullish technicals on every metric, from just flat out technical analysis to the distortions on all the delivery mechanisms, the LBMA, all of the things that China and the BRICS are doing, and Saudi Arabia and Russia and India, and now the U.S. calling it a critical mineral, and gold. I mean, gold is going to back the system. It's going to back a common trade settlement system in the BRICS nations. It's going to back the treasury market.
Gold and Bitcoin are entering a historic moment in global finance. Many investors believe that gold at $4,000 is high, but it remains undervalued considering the massive amount of fiat money being printed worldwide. Commercial banks are going long while managed money sits near record short, setting up squeezes and margin calls in the coming weeks. Global accumulation by China, India, Russia, and BRICS nations, combined with gold's recognition as a critical mineral in the U.S., positions it as central to trade settlements and the treasury market. Bitcoin continues to track gold over the long term, highlighting growing demand for sound money outside government control. Lepard, veteran macro strategist, and Andy Schectman, founder of a leading precious metals investment firm, both warn of an unavoidable outcome: dramatic revaluation of gold and Bitcoin. Lepard notes that institutional investors are waking up to monetary debasement, while Schectman points out that gold stocks remain undervalued relative to the rising gold price. Both emphasize that limited supply, government-independent assets will continue to attract capital. Analysts predict gold could rise to $10,000 to $50,000 in the coming years, while Bitcoin may multiply significantly alongside it. Gold stocks, still trading below fair multiples, could double or triple as profits adjust to higher gold prices. Volatility is expected, but it represents opportunity. The combination of monetary debasement, institutional awareness, and global accumulation sets the stage for historic gains in both precious metals and digital assets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is a chart. This is from a New Orleans investment presentation, which I just gave at the conference. So notice, same chart as before, Bitcoin and gold. Gold, in this case, is white, and the Bitcoin is orange. And if you lag the two, what you see is that, again, they match up better. They match up more closely when you do a 100-day lag. And so, again, over here in 2025, what we've seen is, as we all know, in September, gold really broke out and went on a tear. It went up to 4,400. Bitcoin's just sitting right here. But that means it's pretty, in my book, it's pretty close to probably following through. So I just think it's another interesting data point about, the trend on both the assets. And I mean, the important thing, David, I know you understand it very well because it's the area you cover, is that what's happened is the world has become very aware of this monetary debasement trade. You see JP Morgan talking about it. I mean, I was shocked to see Morgan Stanley changing their allocation. They were 60% stocks, 40% bonds. Now they're recommending 60% stocks, 20% bonds, and 20% gold. And I was like, wow. I mean, they manage trillions and trillions of dollars. And so you're seeing a growing awareness of what those of us in the sound money community have been saying for, decades, but most particularly the last few years, which is they just can't stop printing money. And, we're now seeing, as we move into current events, and I'm sure we'll talk about this, we're now seeing all kinds of indications. I mean, Powell at the recent press conference said the money, the balance sheet would have to grow. Lori Logan, one of the Fed governors, she said indeed the balance sheet was going to have to grow. I mean, this is really QE. Now they're not calling it QE. They're just saying, well, we're just expanding it to make the plumbing work. And, okay, that's a nice excuse, but let's face it, it's money printing. So, the market has figured that out, and that's why gold and silver and Bitcoin prices have been so strong. Gold going up, or is it the dollar going down? and the same with Bitcoin. And I think that, I think the reason I define sound money is money that is not issued by the government, because we all know the government can print more, and money that has a fair set of rules around it. And, gold is geologically constrained, and, you can't fake an ounce of gold, although people have tried. And Bitcoin is mathematically constrained. Those sound monies with limited supply outside of the government system, in my opinion, those are the only sound monies that exist. Now, compared to fiat money, the government's money, they might, the prices might fluctuate a lot, but I actually think that's more of a commentary on the fiat than it is on the sound money. I mean, 1 ounce of gold is 1 ounce of gold, one Bitcoin is one Bitcoin. I think the reason the prices have been so volatile in this transition period here is I think we're going through a period where fiat is really being questioned. And, you're now, I mean, I like to liken it to like we're in a theater and there's a little bit of smoke and a few people are like, whoa, hang on a second, I want to get out of here. And pretty soon everybody's could figure it out. And, I mean, a lot of people think the price of gold at 4,000 is high. I don't. I think it's low. I think gold's going to 10,000, 20,000, 50,000 because that's how much fiat money has been printed, in the same way that I think Bitcoin is going to much higher prices too. So to me, the volatility is more a comment on the loss of faith in the fiat system. I mean, if you look at a chart of what happened in any great hyperinflation, it always starts out slowly, but then over time, money is a confidence game, and if it comes to the point where we all lose money or all lose confidence in the money, it's gonna fail very quickly, and so and it'll be very volatile. I mean, I'm sure you've seen the Mermican Capital chart that shows the volatility, right, during Weimar. So let's talk about the gold stock market. So gold stocks were just criminally undervalued a year or two ago, and we're undervalued when gold was 2,600. Gold at 4,000 or 4,500, their profits have in many cases doubled or more than that. Okay. And so the stocks went up a lot this year. I mean, the averages are up about 100%. My fund was up 130 through this September. And they've gone up a lot. And so the natural reaction is, oh gosh, I've got a profit, maybe I should take it. And I get that. And I've selectively been selling some that went up too much, in my opinion. But if I had to put this in baseball terms, I would say we're in a gold stock bull market, and I think we're probably in the second inning, because they really, even though they've gone up, they haven't fully adjusted for the new higher price of gold. And I don't believe we're stopping at $4,000 gold. I think we're going to gold 5, 6, 7, 8, 9, 10,000. And so, let's say we did stop here. For sake of argument, let's say 4,000 is the peak in gold. I still think the stocks could double to get their cash flow multiples to more like market multiples. I mean, and then in turn, if we take the price of gold up even higher, well, then you're going to be applying that new higher multiple to a higher profit piece. So it's new people coming into my fund. They say, what can I expect? And I say, I don't know. I don't know how high the price of gold will go, and I don't know how much these stocks will go. But I don't think you're too late. I guess to somebody who's looking at buying gold stocks, I don't think you're too late. I mean, you definitely missed the first inning or two, and maybe even the third inning, but it's a 9 inning game at least, and I'm pretty confident that these stocks will at least double again from here in the next several years. And after that, it gets fuzzier. Do we get fiscally responsible? Does the gold price stop going up? I mean, there are a lot of different factors that'll come into play, but my point is that I don't think the gold bull market is over. And but having said that, could we correct 20% from here? Oh yeah, absolutely, tomorrow. The gold stocks are up 100%. Could they go down 20% so they're only up 80%? Absolutely. But in my view, that would be a buying opportunity, not there's no reason to sell them right here. And I have new investors come in. They say, what can go wrong? And I'm always thinking about what can go wrong. And people laugh when I say this, but I'll say it. What could go wrong with this thesis? The U.S. federal government gets really responsible.
Yeah.
And you'll laugh, I'll laugh. We know that right now, given what we can see, the odds of that seem pretty damn low, right? But if the crisis develops and gets even worse, if the boomers have less voting power, and the younger generation say, hey, we got to cut back these entitlements substantially. If we make peace around the world and close down our military bases. I mean, these are all things that feel like a long shot today, but at some point in time, we might fix that stuff. And if and when we do, and they're not printing as much money, well, then there's not going to be as much need for this stuff. But like I say, today I don't see any evidence of any of that. So, to me, I've got a green light, for these things to go higher. And I think we're just, I think we're at the stage. I mean, here's another interesting stat, David. You'll like this. It was in my quarterly report, which, by the way, is on my website,
Yeah.
ema2.com. 62% of the country owns less, well, 40% of the country owns zero gold. These are investment. Bank of America, survey of US investor accounts, 40% gold allocation, zero. Okay. 22% gold allocation, less than 2%. Okay. So 62% of the country effectively owns no gold. Okay. Gold allocation over 7%. It's like, 10% of these accounts. So, this is not the way bull markets end. I mean, bull markets end when, everybody and their brother is talking about gold stocks and the price of gold going to 20,000. And, we're still at a stage where the world is just kind of waking up to this whole thing. So, and what you want to do in investing is you want to find a trend and get in front of it. And, and yes, these things have moved 100%. Okay, I get it. You might think you've missed it, but my sense is that they're going to move 200, 300, 400, 500%. I mean, I can't guarantee any of those numbers. I feel
Sure.
pretty confident about the next 100, but after that, it gets fuzzier. I don't think the Genius Act is going to bring economic chaos. I think the Genius Act was just a recognition of the fact that we live in a digital age and that digital currency is a part of our future. I think that Bitcoin is really the only digital currency that should be or will be a part of our future. But the Genius Act is just encoding that. And I think it was done by the states and the US. And I think the reason Trump embraced it was that enough people that are involved with Bitcoin and all cryptocurrencies in general said, hey, sir, you realize that China's betting on gold, and yet the future is probably in digital things. We're going to be better served to have clear legislation and rules about how to do these digital things. And so, in my view, that's what created the Genius Act. I think what Barry's doing there is he's extrapolating to assume that all kinds of bad things might come out of it. And look, it's entirely possible that Amazon or others, and they're, sadly, it does allow anybody to do anything they want, with cryptocurrency, or not anything they want. There are rules and laws around it, but it makes it clear what the laws are for crypto. And some would say, well, that's going to lead to a lot more bad crypto, and it might. I don't know. I mean, I don't think Amazon coin's going to catch on. My view is it just codified the rules surrounding the existing crypto system, and it's a net good thing because it allows people to know what the guardrails are. I think at the end of the day, Bitcoin is going to emerge as the one cryptocurrency that matters. I mean, you won't, all these other currencies that I don't like, I think a lot of them won't be around in 5 or 10 years.
Gold and silver are entering a historic phase as institutional allocations and global demand surge. Top financial strategists are now recommending unprecedented allocations to gold, while major banks and commercial institutions navigate record short positions and margin calls. Supply constraints are intensifying, from high lease rates in London to delivery bottlenecks on the LBMA and COMEX, alongside refinery outages in India and surging demand from China. The combination of rising industrial usage, geopolitical accumulation, and limited availability is creating conditions for a massive repricing. Bullish technicals align with structural imbalances, suggesting both metals are positioned for sharp upward moves. Meanwhile, confidence in fiat currency continues to erode as money printing persists and government debt expands, reinforcing the appeal of alternative stores of value. Market volatility is inevitable, but the broader trend points toward substantial long-term gains and systemic adjustments. Let's get back to the interview.
You have Jeffrey Gundlach, the bond king, saying 25% allocation to gold is not overweight. This is a man who's made his money selling bonds. He's the bond king. Now, what financial advisor would ever say 25%? Michael Hartnett, Bank of America.
Jeffries.
Well, Michael Hartnett of Bank of America, his newsletter is probably 10 grand a year. He speaks to the institutionals. He's saying 25% gold, 25% bond, 25% short-term treasury, 25% stock, 25% gold. Jeffries is saying 6,600. They used to be a primary distributor for all the major mints. They know gold. And then you look at Goldman Sachs that is saying $5,000 gold if the Fed loses independence. Well, Stephen Mirren is at the Fed. He was Trump's analyst and the architect of the Mar-a-Lago. There is no independence.
And BofA up their silver target to 65.
65 and 56 on average. What do they really think? They keep changing it and moving it higher. You can't be tripped out by a move like we saw. But I will tell you what is uniquely different on top of 39% lease rates in London. You got to cover a position, yeah, it's only 39%. Or 19% borrowing fee for SLV, really, 19%. Or record deliveries in COMEX, or record shortages on the LBMA, or lines all over the place in Singapore, or outages at the biggest refineries in India, or massive outages in retail silver in China. I don't care what you look at. The Chinese flying all over the world buying doré and concentrate. If you don't see the bigger picture right now, you're missing what is a generational opportunity, but it will not go straight linear higher because you have some of the world's biggest banks on the planet who are massively short, who are now getting margin called and can't borrow the silver unless they want to pony up 39 or 19%. SLV, which is so stupid and it's run by JP Morgan and BlackRock, you can naked short it. So in order to get those shares back that you shorted, to buy them back, you're going to pay a massive fee. No one wants to sell them or to borrow them to you. Anyways, the bottom line is that what we saw Friday, the demand has overwhelmed it again. And that's what's different. In years past, the neck would have been broken and we never would have seen these numbers again. And here we are today, and it's right back almost exactly where we were on Friday. If the commercial banks go long and the managed money is nearly record short, how do you think this ends up in the next few weeks? It's called squeeze. It's called margin calls. It's called, if I had a gun to my head, silver goes much higher very soon here as that managed money position starts to unwind. It's going to happen. The bullish technicals on every metric, from just flat out technical analysis to the distortions on all the delivery mechanisms, the LBMA, all of the things that China and the BRICS are doing, and Saudi Arabia and Russia and India, and now the U.S. calling it a critical mineral, and gold. I mean, gold is going to back the system. It's going to back a common trade settlement system in the BRICS nations. It's going to back the treasury market, I believe, and Judy Shelton certainly does keep saying it. Things are changing and the prices are going to go higher. Get used to volatility. $100 is only 3%. If one big bank fails to deliver, the systemic contagion is off the charts, because these banks aren't just bullion banks. They're commercial banks that have their fingers in every pie across the globe. And then it starts to erode confidence like that, which begets more selling, which begets more fear, more panic, more craziness. And when you talk about the potential for some sort of a delivery distortion on the LBMA, it's real. They have 140 million ounces of free float, of which they're trading 600 million ounces a day. There's 2 billion contracts, 2 billion ounces in contracts that are out there that could stand for delivery against 140 million ounces. Now, what could possibly go wrong? But just so you know, when you short a contract on COMEX, most of these banks will go long in London.
Correct.
And so all this delivery coming back, is it the commercial banks covering their positions? Is it the Treasury Department under the Exchange Stabilization Fund? Who is bringing in all this metal? Is it China working with JP Morgan? Who knows, right? We don't know. And it's very interesting. And I watched from Eric Young did a really cool thing about, it's on X. I think everyone should watch. It's a 5-minute video about the Rockefellers and Fort Knox. And there was a whistleblower during the Reagan administration who basically said that this needs to be looked into. Reagan created a commission and it went all the way up to the Senate, and came back and they said that, yeah, we don't have the metal that we supposedly have. The whistleblower was one of the Rockefellers' personal assistants who basically mysteriously fell out of her 10-story apartment building.
Jeez.
And he just published this yesterday. Eric Young, King Kong on X. Check it out. It's fascinating.
The bet that I'm making, and the bet that those of us who are betting on these alternative currencies, and that's really what they are, because the dollar is the leading currency still, despite the fact that it's slipped, is that the market's bigger than the government. And if people, it's called Gresham's law, right? If people continually lose faith in the government's ability to control the printing of their paper, then they're going to select these other forms of money, and pretty soon nobody will want the dollars. And we all have seen the stories of Venezuela where the bolivar was just laying around in the streets because they're worthless. And so we're not anywhere close to that. I don't think that's not even a tail. It's a remote tail case. But my point is that great inflations have occurred when governments have misbehaved. And I think that what's going on now, and this is reflected in the JP Morgan comments and others, is that more and more people are coming to realize that the government is really behaving responsibly or irresponsibly, and that quote unquote irresponsibility is growing. Let me give you an example. So Trump got in, and they established Doge, and it was a noble effort, the Department of Government Efficiency. And Vivek and Elon were going to go save, and Elon said, we're going to save $2 trillion. I mean, it's ridiculous. And they said, we're going to save $1 trillion. Well, that's still pretty aggressive and ridiculous. Well, now it looks like if you Google it or chat GPT it, it looks like they're maybe saving $100 billion a year, which is still a lot of money, but in the context of a 1.8 trillion deficit, it's not that much. And then in turn, the big beautiful bill, which just the Trump, Republicans just passed, increased the spending by 300 or 400, billion a month, or I mean a year. And now the tariffs are bringing in some money, but it's now, I read in the Wall Street Journal this morning, it's looking like he might lose the Supreme Court case on the tariffs. And I guess the point is that intelligent money managers are seeing that the government is just trapped and they just keep printing money. And it's actually kind of math, David. I mean, when you have a credit system that's based on debt and the debt is continually growing, if you don't grow the underlying supply of the money, the debt would default and you would have a big deflation like 1929. And so really they have to inflate. What they're hoping to do is inflate slowly enough that fast enough to keep the system together, but slowly enough that people don't revolt or don't complain or don't leave the dollar. And that they're kind of zigzagging back and forth. But and I mean, obviously they blew it. COVID came along, they grew the money supply 40%, inflation shot up to 9%, right? And then Powell said, "Holy shit, this is a problem." He slammed on the brakes, took rates up very quickly, and inflation's come from 9 down to 3. But even the 3 is not their target. Their target's 2. But now they're kind of saying, well, 3 is good enough for government work, and the financial system is seizing up. We got to cut rates again, and of course we're going to get another wave of inflation. So that's kind of how it works, right?
Let's talk about your book.
The markets for gold, silver, and Bitcoin are at a critical turning point. Record short positions, tightening physical supply, and rising institutional allocations are setting the stage for unprecedented price action. Gold is increasingly being recognized as a core monetary asset, supporting trade settlements and the treasury system, while silver faces acute supply constraints across global refineries and delivery networks. Bitcoin continues to track sound money trends, reflecting growing demand for assets outside government control. With technicals bullish and global accumulation accelerating, the potential for rapid repricing is real, creating opportunities for long-term wealth preservation. Market volatility will likely remain high for those who position themselves early in sound money and precious metals. This is a generational opportunity to protect and grow capital, while the fiat system continues to weaken. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.